Hey guys, welcome back for the last lesson of this chapter, lesson 1-3. We're going to kind of expand a little bit more on lesson 1-2. This is kind of how accounting generally works. It's going to build on each other. So it's really important you get a solid understanding of these basic concepts as we go through, and I'll give you a lot of opportunities to practice those things. But definitely make sure that you feel comfortable with this as you go on, because again, it's only going to get more difficult. And so you have to have this basic understanding of the accounting equation and how different things impact that. So there's a little bit of a memorization piece with it, but there's always resources for you to go back and visit to help jog your memory. But to try to start to have an idea a little bit about how these things impact one another is really important. So put in the work, especially at the beginning, and it'll just make the rest of the course a lot easier. In lesson 1-3, we're going to be looking mainly at transactions that impact the owner's equity portion of the accounting equation. And we're going to talk about revenue, expenses, investments, and withdrawals. So transactions that affect owner's equity, remember that's one part of our accounting equation. Assets equals liabilities plus owner's equity. Owner's equity is impacted by withdrawals, investments, revenue, and expenses. In general, revenue and even sales on account, just like when he bought supplies from that Canyon office supplies, but he didn't pay for them all right away, you still count that as revenue, as a sale on account. So you count it at the time of sale, not necessarily when you receive the cash, but you classify it a little bit differently. So revenue and sales on accounts both increase owner's equity. Revenue is recorded again at the time of sale, regardless of when the actual payment is received. So this chart right here is important throughout this, so you can kind of refer back to this as you're working with these different transactions. So let's have a look at our first transaction. So again, we're going to be working with, and we know that all of these transactions in this lesson are going to impact owner's equity, but we know that that's only one side, so they also have to impact one of the other categories as well. So we're going to see some additional account titles here: cash, accounts receivable, supplies, prepaid, insurance, accounts payable. And as you notice too, it is carrying over balances as we're going along, because accounting does not ever really start over. It's a running total, and so balances are carried over in a ledger. So all these things that you see right here are basically an electronic ledger. And back in the day, people used to have just huge books of ledgers, and it just used to go for years and years and years. And these huge books of all these different transactions were just kept, and those balances were always, always, always carried over. So electronics makes things, and technology makes things a little bit easier, especially in the accounting world. So on January 10th, Delgado Web Services received cash from sales, which is another way of saying revenue, in the amount of $1,100. So again, it's a service business. Delgado Web Services performed a service, and so they received cash as revenue for that. So the impact of this transaction is cash goes up by $1,100, so plus cash here, and owner's equity also goes up as well because it was revenue. Now again, revenue is not profit. Profit is different, but revenue means cash from sales. So when you perform a service, you are increasing cash, and you are going to increase owner's equity as well. Next transaction. And as you'll notice, we're at 6 and 7 because the first 5 that we did were on the previous lesson as well. Again, just to emphasize that running tally portion of it. Transaction number 7 down here. On January 12th, Delgado Web Services sold services on account to Main Street Services in the amount of $500. So again, they sold services on account. It's a sale on account right there. And so even though they didn't receive cash for this, they received sort of a credit. So again, it's that opposite of what happened in the last one, where Delgado Web Services bought supplies on account from Canyon. Now Delgado Web Services performing a service on account for somebody else. So we still consider that revenue. Even though they didn't get the cash, Delgado Web Services didn't get the cash, we still consider it an asset because somebody else now owes us. So it goes into accounts receivable, which means Main Street Services, that's who they provided that service for, owes Delgado Web Services $500. So the effect of this: sold services on account, accounts receivable goes up by $500. The equating recording that we do on the right side of the equation to keep everything in balance is that owner's equity again goes up by $500. Revenue, revenue. They look different over here, but they're both considered revenue. They both increase owner's equity. Next transaction. Just note real quick here, again, on the left side, we have 3,720 on all these different things. If we tally all of these bottom line balances and we tally these balances, they are equal. Again, keep everything equal. Everything has to be in balance. Next, we'll work with expenses. So unlike a liability, which is an amount that is owed, the cost of goods or services used to operate a business is called an expense. When the business spends money to conduct business, when Delgado Web Services spends money on things like supplies or whatever, it's considered an expense. So some common expenses can also include phone and internet, can include rent for the office space that they're using, any advertising that Delgado Web Services does to promote their business, and utilities like electricity for operating out of wherever they conduct business. So an expense transaction here. Delgado Web Services on January 12th paid cash for communications bill for cell phone and internet service of $80. So they paid cash. Again, you know that paying cash always decreases the cash account. So we're going to record when they paid $80, negative $80 in cash. And again, in this lesson, we're looking at owner's equity. Expenses always decrease owner's equity. So negative $80 in cash, negative $80 of owner's equity right over there. And again, if we tally all balances on both sides of our T-chart, they are equal at $3,640. Next transaction, paid cash for equipment rental of $400. So again, just like the last time they paid cash, our cash account is going to go down by $400. And it is also an expense, again, because they're renting equipment. Again, rent is a common expense, whether it be for like a building space or for equipment. Still decreases owner's equity as an expense, minus $400 here. Everything's equal on both sides at $3,240. Other types of cash transactions could be a withdrawal. So, for example, Michael Delgado, the person, withdraws money from the business account for personal use, would be considered a withdrawal. So, what's going to happen when Delgado withdraws money from the business, received is going to be right up there. Actually, no, this is different. Now we're actually going to work, so I'll take that back. Now we're going to talk about receiving cash on account from Main Street Services. The withdrawal is down here, actually, but we have another transaction kind of first. So we'll get to the one I was just talking about. So transaction number 10, receiving cash on account from Main Street Services. So remember, Delgado Web Services performed a service for Main Street Services, and they had owed Main Street Services, or Main Street Services owed Delgado Web Services $500. Now they're going to pay a portion of that bill in cash. So Delgado Web Services received cash, $200. Cash goes up. They received it on account, so then the accounts receivable goes down by $200. So again, nothing happens over here on the right at this one point. This is sort of a review from lesson 1-2, kind of mixed in. But again, a plus and a minus cancels each other out. Everything here and everything on the right-hand side are still in balance. So now let's go back down to what happens when Delgado withdraws money from the business for personal use. He takes $350 in cash from the business for his personal use. That would decrease that cash account. Here it is, transaction 11. decrease that cash account by $350, and decrease owner's equity also by $350 because it is a withdrawal. So balances are still the same, both sides. Here's just a summary of the changes in owner's equity that we went through. Not going to go back through that. You guys can flip through as necessary. But then also, just like the last lesson, here is the answer to the first problem that you're going to be doing in the MindTap website on page 22. Go through again and look at what happens to both sides of the accounting equation when you receive cash from sales, sold services on account. So when you receive cash on sales, when you receive cash from sales, that's revenue. So we know revenue, receiving cash always increases the cash account. So a plus there increases that, and it also increases owner's equity there. So here's the answers as you go through, work through those, and then again, just like the last one, on MindTap, lesson 1-3, you are going to go in, and there's two parts, just like the last one as well. I gave you the answer to the work together problem right here. Then do the one on your own there. So this is the same one that I just gave you the answers to. So if you want to try it yourself before you actually do it, go through, enter your pluses and your minuses as you go. So cash from sales again, cash goes up and owner's equity goes up. Now, one thing to note, I think it'll do it here. We'll see. No, never mind. I thought it would give you the wrong answer as you're going through, but it doesn't. So make sure you're trying to do these and do them correctly. Revisit the slideshow, revisit the textbook for help.